Hello and welcome to the show. My name is Eric. In any business, tax obligations are quite unavoidable. And we understand that managing your business tax obligation can be both complex and daunting task for you. And that's why we're here to help you navigate the intricate world of taxation with confidence and ease. Just to remind you that we have a comprehensive range of tax services that are designed to optimize your tax strategy, ensure you're compliant, and address any tax disputes that may arise. In today's issue, we are going to talk about something that is very new, and that is digital service tax in Kenya. In this video, I'm going to provide you with a comprehensive breakdown of what digital service tax in Kenya is. In this aspect, you're going to look at the scope, requirements, implications, and how businesses can stay compliant with the latest tax regulations that pertains this. So, digital service tax, DST, was introduced in Kenya by the Kenya Revenue Authority under the Finance Act of 2020, and it became effective on January 1st, 2021. And the main objective of this tax was to ensure that businesses that generate their income from providing digital services within Kenya can contribute to the country's tax revenue. So next we look at what are the key features of DST or digital service tax. The first feature is we look at is the tax rate. What's the tax rate of digital service tax in Kenya? The digital service tax is set at 1.5% of the gross transaction value. And this applies to the income generated from the provision of digital services to users in Kenya, even if the service provider does not have a physical location or a physical presence in the country. This means that even if the company is outside the country but provides digital services to Kenyan consumers, they are required to pay 1.5% of the gross transaction value. The second aspect of digital or feature of the digital service tax is the scope of transaction. And digital service tax applies to a range of digital service that includes online marketplaces such as e-commerce platforms like Jumia, Amazon, and local online stores. It also applies to digital advertising services on platforms such as Google Ads, Facebook Ads, Instagram Ads, YouTube Ads, and so on. It also applies to streaming services on subscriptions such as media contents like Netflix, Spotify, and YouTube Premium. It also applied to ride-hailing and digital platforms such as Uber, Bolt, and other transport or delivery services. This tax applies to both residents and non-residents of Kenya that are providing digital services. The main criteria being that the service is consumed by a user who are living in Kenya. The third aspect of digital service tax is exemption. There are certain services that are exempted from digital service tax, and this includes the transactions involving business-to-business digital services. So if a business is providing B2B digital services, those transactions are exempted from DST. We also have services consumed by users that are outside Kenya. So if you are producing content or you are providing digital services and your consumers are not in Kenya, you are exempted from paying digital service tax. Also, you have providers of digital services who are registered as tax residents in Kenya, and those who do not meet the revenue threshold are also exempted from digital service tax. Fourth aspect that we are going to look at is who is affected by the digital service tax. Digital service tax affects all businesses providing digital services that earn revenue from consumers that are inside Kenya, whether or not they are physically present in the country. These businesses are required to comply with the DST, and this includes international technology giants like Facebook, Amazon, Apple, and Google. Also, local platforms that provide digital goods and services, including e-commerce, entertainment, and transportation. Just like if you look at it, such as Jumia, Uber, they are affected by digital service tax. Moving ahead, we are going to look at the implication of digital service tax for businesses within the country. The number one is the compliance requirements. Businesses that are subject to digital service tax must ensure that they are registered with KRA for tax purposes. They register with KRA for the purposes of compliance. They must file regular returns that detail the income they generated from digital service provided to consumers in Kenya. They also have to pay taxes on time to avoid penalties and interest, and they are also supposed to provide accurate records of transactions that involve digital services that are consumed by Kenyans. In these aspects, companies need to ensure that they track and report their digital sales accurately, as failing to comply with digital service tax applications or regulations or requirements can result in very serious penalties. What is the impact of digital service tax on businesses, or rather on local businesses? Local businesses that are providing digital service, like we mentioned them, they are also required to comply with the digital service tax, and this may involve updating accounting systems, educating staff about the tax requirements, and working with tax professionals to ensure that they are compliant. So the next aspect we are going to look at, as a business, how can you stay compliant with digital service tax? To ensure that you remain compliant with digital service tax in Kenya, as a business, you should consider various aspects. The number one aspect is you need to look out for professional advice. And in this aspect, you need to engage a professional or consultant that will help you navigate the complexities of digital service taxes. You learn that tax advisors can provide tailored guidance based on your business model that can help you understand which services are taxable and how to stay compliant with these regulations. The next thing that you need to do to make sure you stay compliant with digital service tax is to automate tax calculations. And in this aspect, you can invest in accounting and invoicing softwares that can automatically calculate and track your digital service tax. This will make it easy to file returns and pay your taxes on time. You also need to monitor changes in tax legislations or tax laws. Digital service taxes laws may change as the digital economy continues to expand, especially with advent of the changing technological landscape, and you need to keep up to date with any changes and make amendments to tax regulation to ensure that your business remains compliant. Another aspect to remain compliant is to ensure your team is well informed. Ensure that in this aspect, you as a business need to ensure that your finance and accounting teams are well informed about the digital services tax and what are the key requirements. In this case, you need to offer continuous training on tax compliance, and this is important to prevent mistakes and any delays in tax filing. So to conclude, I would say the digital service tax in Kenya is part of a growing global trend by world governments to ensure that digital services contribute to national economies. This tax affects businesses that operate in digital space, especially those that offer services to Kenyan consumers. And by understanding the scope of digital service tax and staying compliant with tax regulations, as a business, you can avoid penalties and play a part in supporting the growing tax base of the country. If you have any questions concerning or any area that you have not quite understood or an area that you are not clear about the digital service tax, you can drop us an email and we will answer your question appropriately. Thank you for joining us, and please subscribe to help this channel grow.